Property has always held a powerful place in South Africa's wealth story. For many investors, it feels tangible, feels familiar, and for some, it feels like one of the most reliable ways to build long-term value. And in Cape Town in particular, the conversation around investment property has become even more prominent, with many people searching for where to invest, how to approach property investment, and what to consider before buying. Top of mind for many property investors is how to protect the property itself, but today we want to look at a risk that is often less visible. Hello, I'm Motheo Khoaripe. Welcome to Everything Counts. So what happens to your home loan if the person behind the investment is no longer able to earn an income due to illness, injury, or disability? And is ordinary life cover enough? Today I'm joined by Sinenhlanhla Sithomo, Head of Insurance Business at Investec, and Elsie Rateiwa, Head of Financial Services at Lightstone Property, which provides crucial market intelligence on properties in South Africa. And just to start with the broader property conversation, somebody's putting together their wealth strategy. What should they consider when it comes to property?
Property is still one of South Africa's best wealth builders, and property is very different to your other types of investments in that because it's illiquid and usually leveraged, if something bad happens, what happens next is going to be magnified. But that being said, an investor should still view property as a strategic investment that can be used in order to diversify their portfolio.
Sinenhlanhla, when people talk about property as an investment, sometimes they see it as a sure investment, something you can put in your money and you'll definitely get a return. But as Elsie has also alluded to, there are some risks there. So what is there to consider?
There is a much broader wealth building strategy that people typically have, and an investment plan is just a roadmap of how you go about doing that. And for me, I think for most people, property is one element of that investment plan. It's an essential one for most people because sometimes you live in that property, otherwise you'll pay rent elsewhere. But I think for most investors, it is one element that can be much more tangible compared to equities or to bonds or cash.
Someone come in really quickly and get their return and leave? Or is it something that you have to know that you're going to be in it for the long run?
If you want to get a return on your investment for capital, you're looking at a minimum of 5 years, 5 to 7 years. Potentially longer if there's a downturn in terms of the interest rate cycles and just economic conditions.
On the rental side, typically do it for investment purposes where you buy to let. In the first couple of years, it's really not going to be positive in terms of the cash flows. So whatever rental you're getting, less all the costs that we may unpack later on, they will be negative. So 3 years probably is at most really the shortest, but it typically can run to 5-10 years before it actually turns positive. As Elsie was saying, certainly never going to be a much shorter kind of duration that you will get elsewhere with some shorter duration investments.
A lot of people will tell you about Cape Town, especially when it comes to property, that's the stronger end of South Africa. And if you really want to make your money back tenfold, that's where you go. Is that a misconception?
So it's not a misconception. Cape Town, you should believe the hype. There's greater demand than there is the supply of stock in that area. So in the last probably 20 years, if we look at the growth in Cape Town, it's about 39%. Over 50% of that growth actually has been over the last 10 years. So the momentum there is building. There are other growth nodes such as Ballito, Rustenburg, Waterberg, but that growth has steadily come over the last 20 years.
Sinenhlanhla, putting together that portfolio then in the South African context, not really advisable to throw all your money in Cape Town because there are other growth opportunities.
Depends also of your pockets and your capabilities to finance the property. For some people, property, especially if it's their primary residence, will be quite a substantial investment that they're making. It's a large portion of their portfolio. But some people, it's actually not. When they've got such a big capacity in terms of the asset base, it may be quite small. And I think then how you think about where you're going to be investing, obviously the risks in terms of the area and how much growth, potential growth can still unlock out of Cape Town is one of the questions you need to lie your mind to versus other areas that could still experience such growth. Obviously, the convex is also true in terms of the expenses and the costs of keeping that property over, say, 10, 20 years is really a very strong consideration whether that investment is going to be fruitful over time or not.
And that's a strong consideration, Sinenhlanhla, in terms of being property rich. You can buy the property, but if you're cash poor, then it doesn't work out as well because you still need to maintain it and keep the value.
I mean, I've seen some friends showing me some of their cash flows and how they're thinking about going into property, and people having 10, 20% appreciation over time that they're expecting. I mean, you're very, very optimistic there. Yeah, I'm not sure how realistic that may be. And also just being realistic about your true cash flows that you might actually be getting there. And that applies whether you are doing it for investment purposes as a rental or it's your primary residence. I always see, especially from a banking side, people aiming to look for a property at the top end of what they qualify for. What you qualify for is not necessarily the target, because you have to still build room such that your repayments each month still leaves room to pay for all of the cost of maintaining and keeping that property. So certainly being able to think about those things in a much more deliberate manner is quite important.
If I just can add to that, you mentioned earlier, what are the risks? One of the risks there is concentration risk. If you're buying in Cape Town out of sentiment alone, potentially when the market takes a downturn in Cape Town, you'll then also be negatively affected by that. So you do want to make sure that you don't have concentration risk, but also taking into account things like climate risk. More and more climate risk is becoming financial metric more than it is just an environmental metric. And so understanding that within the Cape Town area, what are the different climate risks can inform your decision to buy property as well.
So things like wildfires or floods. Let's look at those hidden costs then. People buy the property, they've got the money, they're thinking now and they'll get the return later. But what are those hidden costs that you still have to account for as you invest in the property?
Well, I like to always think about costs in two buckets. The visible direct cost that I think everyone can get their heads around and think about. So whether you hold it for investment or it's your primary residence, or if you hold a home, you still have to pay the municipal rates. If it's a sectional title, you have to pay for the levies. You have to pay for the maintenance of the place. Then we've got the flip side, we've got the hidden costs. Yeah. Things like vacancy. You always have to assume that there will be some months where there's vacancy in between tenants if it's for rental purposes. If it's for your own place where you live in, up front, there is some capital outlay. Other than the deposit to pay for the property, you have to pay for the bond registration, the transfer costs, the events of unfortunate death that may happen, and you unpack some of the aspects of that. All of those for me are typically a hidden cost, but you have to think about because they will be due and you'll have to pay for them.
Elsie, Sinenhlanhla was talking about money leaving my pocket to make sure this investment works. How do you prepare then for buying a property like that, where you have to have a pool where you can get into and make sure that the property retains its value, but also that you can still run it as a proper investment?
So I think the first thing is you need to make sure that you understand the fundamentals. So the old school fundamentals is location, historical appreciation, and your rental yields. Then bring in some of your new school property intelligence. Things like your climate risk, as we've spoken about, growth nodes, and even some of the economic factors, right? And I think in advance, know your facts, know the value of your property, know what are the costs that you're going to need to run, what are the running costs for that property, and then be able to have an amount of cash flow that will enable you to do maintenance as and when required.
And Sinenhlanhla, how do I calculate then my cash flow resilience? I'm investing in a 2 or 3 million rand property. How liquid do I need to be for me to feel like I'm a bit safe with this investment?
Well, first, I think you need to determine whether you're going to finance the opportunity, that property, or you're going to fund it out of your own cash if you have accumulated that amount through your investments or your savings. Most people typically have to finance because there's some leverage and gearing that you get there. You've got the bank financing the deal, and you have to pay deposits and then fund your ongoing cash flows typically. But for me, I think it's just a thorough analysis in terms of first of all, the price you're paying. Is it an appropriate price that you're paying, that you can afford, first of all, to make those repayments if you are financing? And secondly, are you overpaying or are you paying at the right level? Then the second part for me, you have to do those cash flow analysis month by month. And for me, don't be too optimistic. So don't assume that the rates and the levies are going to go up by inflation. Your rental income, don't assume it's going to go up by 10%. You might not be able to get the 10 and it's going to give you a 10% increase in the rent every year. Assume something moderate about how your cash flows could look like. Then you'll get a clear picture how long it might take for you to be able to turn to positive cash flow. And for me, what I've seen in the markets across in South Africa, that it's never shorter than 3 years.
So how do I calculate that return without being too ambitious or maybe expecting a lot of money to return to me?
I think you need to taper your expectations up front, to be honest. Um, so it is easier said than done, but you should taper your expectations up front. The returns you're going to get in property, if you think about it at the front end costs that Sneh has just mentioned, that's at least 8 to 10% of your property cost already. One of the hidden costs is accounting. You need to get an accountant because you must submit your taxes twice a year, right? So now you have an accountant cost there as well. You have rental management costs there as well. So you need to ensure that you understand every single bit of the costs and then taper your expectations in terms of what that return is going to look like.
We know about the contents insurance, making sure that everything in there can be covered. We know about covering the building itself, but what about the income that has bought the building or maybe is maintaining it? How do we make sure that's covered?
Earlier on, I spoke about the various risks. The other aspect to a risk is really your earnings ability. Most of the time, you get funding and financing of your property because you can prove to a bank that you'll continue earning. So that becomes quite important because things can happen, life happens. Events of death, events of disability, throw the spanner in the works. You just take it step by step. Events of death, the property is now left to the family. First, they might not be affair with your strategy, what you were trying to build. So first, they have to get closer to that and understand that. Secondly, can the bank roll over that financing and the funding now to the remaining family members? Do they have the capability and the capacity to finance that deal? And in most instances, the answer is no. And that's when you get the forced sale coming through. That's where you get the best deals.
From what I'm hearing from you, it's not enough to just have life cover. There must be other buffers as well, like the mortgage insurance you're talking about. How does that become an advantage, Elsie?
It's a massive difference between having life cover, having savings, and having a mortgage protection cover.
And those are the tough lessons, Sinenhlanhla, right? Where you find out as you are invested in the property that you've missed out on this, you've missed out on that. When it comes to disability, does it also apply where maybe you were an income earner, but, tragedy happens and then now you're not who you were before? Does that also get some sort of cover that could help out with the mortgage?
Yeah, so that's for me quite an important distinction because you also find lots of investors think that if they've got normal life cover that they're covered, which partially that's true, but there are some challenges with that because it's not necessarily tailored specifically for your mortgage. And a proper mortgage protection cover will also have the disability element that you are alluding to, which means whether it's temporary disability or it's permanent. Take the COVID days. You booked off now for a month because you can't work due to COVID. You're still going to go back to work, but you just booked off temporarily to recover. The mortgage protection cover will take care of the repayments. Or it could be something permanent. Now you are paraplegic, or you've got mental health, or you've got back problems that now do not allow you to continue working. Then mortgage protection cover then pays off the outstanding debts into your portfolio or your property that's linked to that mortgage protection cover. Life cover, normal life cover that we know, bread and butter in South African context, only pays out in the event if you die only. Mortgage protection cover will cover all those eventualities, including dying. So it is a much more comprehensive, tailor-made type of insurance solution for a home loan or someone who's building a property investment portfolio.
Why is that? Why do we tend to cover the things that we own, like your car, your property, but we're the last to be covered? Is it a behavioral science somewhere there?
So the process is focused on the asset. An inspection, you get an electrical certificate. All of this is focused on the asset. But it does take away from you focusing on the individual and the income that actually is going to be the collateral for this asset is equally important.
But also psychologically, if I'm thinking about whether to go and buy in Cape Town or in the Drakensberg or in elsewhere in the country, last thing I want to think about is my death.
Yeah.
So it's not necessarily pleasant thoughts and things to think about, but it's a reality that you have to factor into your investment journey and investment plans.
So true.
Yeah.
And Sinenhlanhla, as we wrap up this particular segment of the conversation, just outline for us the different sorts of cover that you should be having as a property investor.
But just in simple form, for me, there are three categories of insurance in relation to your property. One is your homeowner's insurance. It really protects the structure. Should there be a fire, should there be flooding or whatever, it doesn't impact the structure. And obviously the bank who's financing the property has got a high interest in making sure that insurance is in place. Then there's homeowners content or household content. That is quite important. Typically, if you to turn the house upside down, whatever falls out is contents to the house. It's ensuring that. So against theft, burglary, or anything that can happen to the content, it could be lightning that can impact your TV. And then the last piece is what we spoke about earlier on, which is your mortgage protection cover. So it's really protecting the home loan that you're using to finance the funding of the property. So the life behind this whole investment, which is yourself as an investor, needs to be protected. So that if something happens to you, this won't be taken over by the bank, or it can be passed on to your family in a seamless manner.
Great insights coming out of this conversation. More after this.
We all buy houses for different reasons. For some, a house is just one step to building a real estate empire. For others, it's a place to raise a family, a forever home to live in and pass on to the future. Or maybe it's a getaway, a hideout when you need to escape for a while. Whatever your reason for owning property, keep it in the family with Investec Life's first-of-a-kind enhanced mortgage protection cover. Think of it like life cover for your home. There to settle your home loan so your family doesn't have to. With monthly premiums that automatically adjust to your outstanding balance. Enhanced mortgage protection cover from Investec Life. Made for living, just like you.
Welcome back to Everything Counts. We're talking property investing, the risks that come with it, the opportunities, and also some of the returns. I want us to revisit, Sinenhlanhla, that part where you were talking about, how life cover doesn't completely cover the property that you've invested in. What is the blind spot there, and how can a property investor fix that?
What I've seen for most people, what they typically do is they'll have, they need, let's say, 5 million rand life cover to look after their dependents if something happens to them. And when they buy property, say it's their primary residence for 2 million, as I said earlier on, 2 million, 3 million, they would add to that. So it becomes 6 or 7 million or 8 million rand life cover. The dangers with that is, first of all, the beneficiaries you name there, if you to pass away, it's going to go to those beneficiaries. And you've got a choice who you name it as a beneficiary. So they may not necessarily take that money and go and pay off the home. If you named your uncle who's staying in another town, they might not have an obligation.
Not really interested in your property.
They might not be interested, yes.
Yeah.
Or the other way around, where you don't have beneficiaries nominated, or you leave it to your estate. So when they are winding up your deceased estate, there may be other costs and any other liabilities like your car, your personal loans, your credit cards, and other things that needs to be also settled. So there's also then the friction between what needs to be settled first, and you may actually compromise leaving then your home loan not fully paid off because there's not enough funds available then and left in your deceased estate. Mortgage protection cover is actually tailor-made and specifically made for your home loan. So if you pass away, the settlement does not go to your family. The settlement does not go into your deceased estate. It goes straight to the bank to cover the outstanding balance. And then the family can inherit the property and then decide thereafter. So it's quite those difference and nuance in terms of what happens in the event of death that makes it difficult and tough and can introduce new risks and potential family conflict versus really taking care of your liabilities and obligations.
And does it matter whether the property is the primary residence that you're living in or one that you've used as an investment? You still have to have mortgage for both, or how do you couple that?
To me, it matters, but differently. If it's primary residence, almost always an answer is yes, you have to have a mortgage protection cover. Any financial advisor you'll speak to, you have to have something, a mortgage protection cover, if not life cover, that will take care of that liability. For investment purposes, it's slightly different. You're building a portfolio there. The question there is how much liabilities you want to leave to your deceased estate, because you may have other assets. Say if you've got a nice investment portfolio that is run to a couple of millions, but if you still owe the bank may decide then that your deceased estate must settle your outstanding balance. So now do you want your beneficiaries who are supposed to inherit your other assets to think about channeling those to your property or not? And I mean, other detail that you find, speaking about Cape Town, you're going to in the higher end of the market. You're going for 20 million, 30 million rand property. You still finance it, say, for 50% financing. The question is, that 30 million rand home, that's 15 million that is still financing it for. Where are you going to get that 15 million if you don't have a mortgage protection cover to close that gap should you pass away? It has to come from your assets, your other assets. You should liquidate your shares, your equity. If you own a business, you might have to sell your business. Your family have to sell your business to be able to close that gap. Yeah, that shortfall. So whether it's your primary residence, your holiday home, or it's for investment purposes, you are renting it out, it's always important to make sure that liability does not fall to anyone else, let alone your family, but it could also be your estate.
So when we do talk about property investing, when a financier or bank sees that you've got mortgage protection and life cover, does that play to your advantage?
A bank will want you to have homeowners cover, definitely. Mortgage protection is a plus. It actually is more for you than it is for the bank. So homeowners cover will ensure that your family is covered for the property, but then a mortgage protection, as Sine pointed out, is actually a lot more extensive than that, more comprehensive than that.
Does it get more expensive if you have multiple properties? I mean, that mortgage protection?
I think the mortgage protection will definitely get more expensive as you have multiple properties. But as you have multiple properties, that's when you actually need to consider mortgage protection even more. It becomes that much more important. Sine pointed it out that as you have a bigger portfolio, it means that when something does happen to you, everything is exposed and everything is at risk. So you do need to think about it a lot more when you have more properties.
There is also a benefit. I think everyone spoke about the illiquidity and the diversification issues that you sometimes find with the property. But the bigger your portfolio, the better diversification you get, at least within the property. Because if one property you don't have a tenant, you still have 2, 3, 4 others that may still have a tenant. So the timing then of vacancy becomes less of an issue with a bigger property portfolio than if you have one. If you have one, you don't have a tenant, there's no income coming through. You have to shoulder all the expenses and the repayments. Sometimes being able to plan to have a sizable portfolio that you can still manage against within your capacity is an important diversification effect within your property portfolio.
So all risks considered, everything that we need to think about also considered. I want to come to my favorite part now, the returns. How much time are you budgeting before you can see an actual return from a property that you've invested in?
You're looking at anything between 5 to 10 years. So what the Lightstone data shows at the moment is previously people used to hold on to their property for about 5 to 8 years. And now we've seen that trend move towards all the way up to 13 years. And I think that is just testament to where the times are right now. Selling your property right now, you maybe won't get the returns that you are looking for. And if you don't get the returns that you're looking for, you ultimately will hold on to the property a little bit longer.
For me, it's also important when you think about returns. Is it before, after expenses? Because sometimes you look at an opportunity. I'll just make an example. You're going to Johannesburg or Durban in the CBD. You may find very, very good, attractive rental yields there. But the fact is, if you then counter the costs that are associated, then your rental yields diminish quite significantly. We spoke about Cape Town earlier on. As much as the market looks quite attractive from the capital appreciation side, but the rental yields can be quite squeezed. If you look in the Atlantic seaboard, you're looking at 3 to 5%, which is probably one of the lowest in the country. Obviously, on the capital appreciation side, you may get some good returns, but on the rental side, the yields are just not as great. Again, we spoke earlier on, you could then be using the property for other means like short-term holiday letting that can actually pick up your yields towards a 10, 11, 12% return. For me, it's also quite important to think about return in 2 ways. One is your ongoing rental. If it's for rental purposes, what does that look like and when does it turn positive? And it's not going to be shorter than 3 years typically, but it can run to 5, 10 years also, looking at capital appreciation. When do you get your money back and build that equity with that property, and look at your whole portfolio as a whole. When does it get to finance other properties?
So those returns don't necessarily go straight to your bank account. They could be, used to reinvest into other different properties, or make sure that you also a bit liquid and are able to manage that asset going forward.
Yes, and then the exciting part, not so exciting for most people, but the exciting part is that once you've got those returns, if you have to sell, the taxman is on your door. They're looking for that capital gains tax.
So you also need to put that aside.
You need to budget for that. So as I said, you need to think about returns, gross returns. Don't take into account those costs and taxes. But net returns really gives a reality check to say what will actually ultimately go to your pocket. Most investors will structure their portfolio such that it keeps refinancing other portfolios without having to sell. And that for me is one of the optimization that you then get to ultimately. But that's not where you start.
The popular rule of thumb around investments and shares and things like that is that if people are talking about it, then it's already too late. So with property investing, how do you know, to be a first investor in a particular area? How do you pick up where the next big return is going to be?
I always like to bring it back to the investor. And I find that there's so much opportunity that can come up elsewhere. You have to always be disciplined and understand what is your property investment strategy. So if you are targeting students and now there's a new development that is coming up in Sandton, that's not your market. So if you're clear about what you're targeting, just think and see if it actually fits your strategy.
So as somebody who's listening to this conversation, what should they take away when it comes to property investing?
So data will tell you everything about the property. Data will tell you everything about price and trends, etc. But the one thing that data cannot tell you is about when life will life. So that's the one thing that you actually should be looking at, making sure you have a plan for, and that's where mortgage protection comes in.
For me, it's plan, but don't be too optimistic. So be realistic in how you plan. And for all the risks that you may encounter there, make sure that you manage them appropriately in your cash flows. And those that you can mitigate with insurance, ensure that is in place appropriately.
And before going into a property, what should you be looking out for as we close?
What risk does this property have that I can't see today? And to do that, you have to, I would say, get a Lightstone valuation and understand the value of your property. Knowing the value of your property enables you to understand and be able to control the things that you know, and understand what you are actually buying. And then if you can do that, you're able to then understand and manage the risks that you can see and then get mortgage protection for the risks that you don't.
Mortgage protection. And from you, Sinenhlanhla?
From me, it's just maybe also realizing ultimately that it's an investment like any other. However, it's a needy one. So it's not like you need trust that you just now invest.
I think you've opened my eyes to it.
And then you look
the easiest thing. Now I'm just like, there's so much admin that comes.
Because sometimes you're carried away by the sentimentals of the property or the emotions about it, which is fine because it's quite a different asset. But you must realize it's quite needy. You're not going to just invest and look away and hopefully in 10 years, 20 years time, things will have happened to it. No, you grow the value in that property, not only by what you do to it, but how you go into that property, how you select that specific property is quite an important part of that journey and the growth prospects you're going to have.
Thank you very much to our experts, Elsie and Sinenhlanhla, really opening our eyes when it comes to our property investing. It's one of those things that you have to constantly nurse, as Sinenhlanhla puts it, that you can't really put it away and hope it grows. It's something you have to be active with in terms of your investment. If you'd like to listen or watch more of our episodes, then subscribe on Investec Focus Radio SA on any of your favorite podcast platforms. We'll see you in a fortnight.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Private Banking, a division of Investec Bank Limited, a registered credit provider committed to the Code of Banking Practice as regulated by the National Financial Ombudsman.